You're watching treasuries very closely. You believe all the treasuries are headed towards that 4% yield direction. How do you see that impacting the markets?
Yeah, it definitely is going to be a negative for the markets because as you're looking at the UK just overnight, right, they're now well over 4%. And, the currency crisis there as it's unfolding had a big spillover on Friday on our markets and drove up our treasury yields. And then if you take that then against the backdrop that inflation remains high and the Fed committed to fight that inflation, they're going to drive up real rates, as we say, even higher. So the nominal treasury yield accounted for inflation. And that again propels the dollar. So I think describing all those factors, Frank, you can tell that driving higher interest rates or higher treasury yields, yeah, is going to puncture the equity market. So we may retest those June lows, if not below, and then may settle out. So look for 4% 10-year treasury yield.
Yeah, we tested those June lows last week, actually. One other thing I want to ask you about, you mentioned those UK tax cuts. After those tax cuts, we saw the dollar and the sterling reach parity. A lot of people consider that possibly a sign, especially with the euro and the dollar reaching parity as well, a sign of a possible recession coming up in Europe. How do you see rising currency impacting the markets as well? The dollar rising at least 7% this quarter alone.
That's a major negative factor because there's a lot of debt in dollars, for example, in emerging markets, so that gets under a lot of pressure. Then, of course, the current account and fiscal deficit combination, like you're seeing in the UK, only gets worse with a weakening pound and stronger dollar, and it's also in other emerging markets. So there's a big economic effect from a strong dollar. And that, I think, is what's going to continue to pressure markets, at least into this quarter, until that all settles out. At some point, this dollar strength will fade, as also our economy is slowing down. As Fed Governor Bostic say, we need a slowdown. That means there's eventually a weaker dollar, but not at this moment. The pressure on rates is high, the pressure on real rates is high, and the weakness in the pound and euro are just exemplary of recession nearby in those countries, propelling the dollar, and that is not a positive for markets.
All right, Ben, in a recent note, you actually said the Fed's 3.1% core PCE projection for 2023 reflects an admission that they're not going to reach their desired goal of getting inflation around 2%-ish. With that admission, does that change the Fed's hawkishness at all in your mind? And we have obviously a PCE report coming up. So $1 million question, does this week's PCE report impact the Fed's plans at all?
It will, Frank, because, yes, that projection is based upon that they believe they can get inflation down a lot from here, right? Because we're going to have core PCE more around 5 or change. So to get to 3 is a big move down, but to get to 2% will take a couple of years to get there. And so they can take a victory there. And we know from Governor Waller, as an example, he's been saying we have to keep this fight going until we reach 2% and then declare victory. So I think what these projections showed was a idea within the Fed that they do aim for the softish lending. They don't want to obviously damage the economy so much with over tightening the policy. On the other hand, they have more work to do after 3%. So I think in a way it's a mission to get inflation to 3%. On the other hand, it's still a fight to get all the way to 2%. So I think the Fed will keep going till they reach 2%.